What you're about to hear contradicts almost every financial headline published this week. They held a funeral for silver. The eulogies were written. The financial press declared the chapter closed. The metals mania of January 2026, when silver punched through $121 an ounce on the nose, was officially classified as another textbook bubble. The narrative was tidy. Speculators got crushed. Reckless money got disciplined. The market, they assured you, had returned to sanity. And here sits silver at $86, and the average investor reads that number as defeat. But what if the entire interpretation is inverted? What if $86 isn't the wreckage of something that died? What if it's the loaded mechanism of something that hasn't fired yet? This is OG Peter, and you're watching Silver Dispatch. Look at what has unfolded in roughly 2 days. President Trump publicly dismissed Tehran's latest diplomatic outreach this morning. 3 syllables on Truth Social. Totally unacceptable. Iran's supreme leader, Mojtaba Khamenei, responded with what state outlets described as decisive operational directives. The Strait of Hormuz, the maritime artery carrying close to a fifth of global crude, is now entering its 10th week of functional shutdown. Not slowed, not pinched. Shut. However, watch the prices. WTI closed Monday at 98. Brent printed 104. Saudi Aramco's chief executive issued a sobering statement this week. Global oil markets are bleeding roughly 100 million barrels of supply each week. Each week. Let that figure settle. And inside this furnace of geopolitical chaos, silver sits at $86, almost preternaturally calm. No panic spike. No vertical move, just composure. That composure is the story nobody on financial television is brave enough to tell you. But there's a catch, and this is where it gets interesting. Examine the geometry. From the $121 January peak to today, silver has surrendered roughly 29% of its nominal value. Mainstream finance digested this in the laziest possible way. Bubble forms, bubble bursts, normalcy restored, audience dismissed. However, that storyline has one fatal flaw it cannot explain away. If silver was nothing more than a fever that broke, why is the physical metal market behaving like demand is accelerating? Dealers reported widening premiums during the January correction. Mints reported order backlogs stretching weeks. The Silver Institute, the industry's authoritative research arm, not some anonymous newsletter, projects that retail coin and bar demand will climb 18% in 2026. 18% in a year when paper prices retreated nearly 30%. 2 facts that cannot logically coexist forever. One of them is lying to you. The question worth asking is which one, and that's where this dispatch is heading next. Now layer the architectural picture on top of the breaking news, because what's happening in the Persian Gulf and what's happening in the silver vaults aren't separate stories. They're tributaries feeding the same river. The Silver Institute released the World Silver Survey 2026 last month. This document is the industry's definitive ledger, produced by analysts whose professional credibility depends on getting the numbers right, not on selling you anything. The headline figure should be echoing through every trading desk in America. Since 2021, 6 straight years, the global silver market has pulled 762 million troy ounces out of above-ground reserves, simply to bridge the gap between mine output and actual consumption. 6 consecutive deficit years. No comparable modern stretch exists, and 762 million ounces is roughly equivalent to an entire year's worth of worldwide silver mining. Translation? The market has been quietly devouring its own pantry, the inventory cushion accumulated across generations, at a pace that drains a full calendar year of global production every 6 years just to keep books balanced. However, here's the cruelest mechanic embedded in the entire supply equation. Mine production cannot simply be dialed up. Roughly 74% of all silver pulled from the ground globally is not extracted from dedicated silver mines. It surfaces as a byproduct of copper, lead, and zinc operations. Those mines run on copper economics. They don't sink new shafts chasing silver's price signal. They react to whatever pays their primary bills. Consider the proof point. When silver averaged $40 an ounce throughout 2025, a 42% year-over-year leap, total projected mine production for 2026 came in at 844 million ounces. Essentially flat. A 42% price detonation produced effectively zero supply response. Economists call this inelastic supply. Anyone who has ever lived through a genuine shortage of something that cannot be manufactured overnight calls it a serious structural problem. This is where it gets interesting. The Silver Institute deployed deliberate language describing this condition. They used the phrase era of reduced stocks. 4 words carrying the weight of 6 years of measured data. The buffer that historically absorbed surprise demand surges, investment rotations, industrial spikes, geopolitical shocks, that buffer has been materially eroded. When inventory is deep, shocks get absorbed, and the tape barely registers. When the buffer has been hollowed out by 762 million ounces, the same shock produces a fundamentally different market reaction. The system grows fragile in places it used to flex. And the world is currently stress testing this brittle architecture with the largest oil supply rupture since the 1973 embargo. Silver at $86 isn't merely a price, it's a pressure gauge. Now here's something that should genuinely disturb you. The World Silver Survey 2026 hit public domain on April 15th. It contained what any competent commodities analyst would instantly flag as a headline-grade revelation. 6 consecutive years of structural deficit, 762 million cumulative ounces drained. A projected 2026 shortfall of 46.3 million ounces, 15% steeper than the prior year. Institutions don't reach for phrases like era of reduced stocks casually. How did silver close on April 15th? Essentially unchanged, somewhere between $79 and $80. The data landed in public view with the impact of a feather settling onto velvet. This isn't because the market lacks intelligence. It's because paper futures markets are architecturally engineered to price immediate, specific, legible events. Trump labels Iran's proposal garbage. That's priceable inside minutes. 6 years of inventory hollowing reaching a critical threshold. That's not priceable in any single session. It accumulates beneath the radar, invisible to the algorithm, illegible to the momentum trader, until a single catalyst suddenly compresses years of ignored information into a violent repricing. October of 2025 was one such moment. A physical liquidity crunch in London vaults sent lease rates vertical and drove silver above $100 for the first time in recorded history. January 2026 was the second moment. The structural pressure had been compounding for months. The catalyst arrived, and the deferred information detonated into one rapid price expansion. The move looked sudden. It wasn't sudden. It was accumulated reality, finally asserting itself with the blunt authority only physical scarcity can deliver. However, this is where the London Vault data graduates from technicality to thesis. Unencumbered silver in London, the world's primary lending hub, the venue where institutional borrowing of physical metal actually transacts, fell to a historic 17% in September 2025. 17. The remaining 83% was already committed, already pledged, already attached to someone else's obligation. That was the tinder. October was the spark. And here we are in May 2026. Brent at $104. Hormuz in week 10, a ceasefire the sitting president described as surviving on 1% life support. Meanwhile, COMEX registered inventory, the metal physically available to deliver against futures, sits near 88 million ounces, down from roughly 346 million ounces not long ago. A collapse exceeding 74% in deliverable supply. But there's a catch. Industrial buyers don't trade silver, they procure it. Solar manufacturers, electronics fabricators, EV component producers, medical device makers, they cannot afford to wait for a green light from the future screen. The cost of running out isn't a trading loss. It's a halted production line. Now examine the broader monetary canvas, because silver does not exist in a vacuum. It exists inside a global financial architecture under its own particular strain. Washington is currently borrowing roughly $2 trillion in new debt this fiscal year, more than $166 billion every month. Long-dated Treasury yields are elevated not purely because of inflation expectations, but because investors are demanding what economists label a term premium, extra compensation for the uncertainty of holding government paper across extended horizons. Jamie Dimon at JP Morgan has been sounding this alarm across successive annual shareholder letters. This is not fringe analysis. This is the largest bank in America, whose research division simultaneously published an $81 silver target this year, specifically citing the structural supply gap. These aren't contradictory positions. They're two reflections of the same underlying truth. Paper assets of every variety carry embedded counterparty exposure that physical metal simply does not. However, central banks understood this before retail did. They've been accumulating gold at a velocity unseen since the early 1970s, 3 consecutive record-buying years. Not for speculative reasons, but because sovereign reserve managers studied the macro landscape and quietly concluded that real asset allocations needed expansion. Silver carries the same monetary repricing dynamic with an additional industrial demand floor reinforcing it. This is where it gets interesting. Permit one honest reckoning with the bearish case, because intellectual honesty is the price of credibility. Silver has surrendered roughly 29% from its January peak. That is genuine pain. If Iran de-escalates, if Hormuz reopens, if inflation cools faster than expected, some geopolitical premium unwinds. None of these outcomes is impossible. However, the bearish thesis requires multiple forces currently working against it to simultaneously reverse. The structural case requires only that trends already in motion continue moving. But there's a catch most analysts are missing entirely. Institutional capital is quietly migrating from paper silver vehicles into physically allocated, audited, vaulted instruments. Sophisticated participants are accepting management fees and tracking friction rather than holding capital-efficient futures contracts. That choice is an implicit statement. Confidence in the paper delivery promise has eroded. Silver at $86, WTI at $98, Brent at $104, Hormuz frozen in week 10, 762 million ounces evacuated since 2021, mine production structurally unable to respond. That is the setup as the data describes it. Drop your verdict in the comments below. What matters more for silver's next major repricing, the Hormuz crisis or the 6-year physical deficit? I read every single comment. Hit subscribe. Silver Dispatch publishes the analysis financial media won't. This is OG Peter. Educational discussion only, not personal financial advice. Think clearly. Decide independently.